Welcome to The Savvy Investor, where it's our job to help you be secure in any economy. Today we're going to be talking about those talking voices you hear on the radio, all promising guaranteed rates of return, 4 to 7%, guaranteed bonuses, income streams. Reality or ripoff? Our guest today, Josh Goulding, is going to set the record straight for us.
Welcome to The Savvy Investor. You can have financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your retirement forever. Each week, The Savvy Investor helps viewers just like you create and grow wealth, protect and preserve it, and distribute it in the most tax-efficient manner. And now, The Savvy Investor with your host, Michael Canet.
As the economy continues to falter, people are looking for safe returns where they can earn a decent rate of return. CD rates have been historically low recently, and maybe 1 or 2%, and that certainly isn't a way to keep even with inflation and taxes. Treasuries and bonds carry interest rate risk and default risks of their own. So where can you go to earn a decent rate of return? What if you need 3 to 5 to 7% just to make ends meet during this volatile times and during your retirement years? Now, we all have heard all these people talking on the radio, the little voices telling us, promising us 5 to 7% bonuses just for coming to visit their company. They're going to guarantee you income for your life. They're going to guarantee you these 5 to 7% rate of returns for income purposes. All these guarantees are thrown at us day in and day out on the radio talk shows. And we're going to talk today. We're going to explore how these guarantees work, how these little retirement plans that are sold to you by radio guys, index annuities, that's what they're called. And we're going to talk with expert Josh Goulding. He's going to explain the truth about these things. Now, before we go there, like we do every week here on The Savvy Investor, we're going to take a look at what's in the news. Now, there's a bunch of stuff out there, and we're going to kind of focus on the index annuity arena. FINRA, which is the people who governs the license of security brokers, they came out with a statement recently that basically says index annuities, a complex case, and it's why an alert on equity index annuities is appropriate now. And what FINRA goes on to say is that, look, these things may be a good vehicle, they may not be a good vehicle, but they're inherently complex and convoluted. There are all sorts of moving parts that you need to understand. How do you make money in these things? And it's not that you can't, it's just that you need to understand. And their concern is that they're sold to you by those radio guys that say, hey, buy from us, buy from us, buy from us, and you're going to make lots of money. Well, the fact is that if you understand how they work, you can make money. But the bottom line for FINRA is they want to make sure you understand the moving parts to make sure that an EIA is correct for you. Now, from MSN Money, 4 ways to protect your portfolio. And it's interesting with these guys. They said an annuity is a contract which an insurance provider makes periodic payments. Now, that's a different type of annuity than we're going to be talking about today. But what they're really talking about is there's fixed annuities, which offer a rate of return. It's a fixed rate of return. There's variable annuities that go up and down with the stock market. And then there's kind of this hybrid, kind of in between, called index annuities. And what MSN Money is suggesting is that, look, if you want to participate in some of the upside of the stock market, but you don't want to lose money on the downside, an index annuity may be the right tool for you. But this goes back to what FINRA said is, make sure you understand how you're actually going to get paid on your annuity purchase. And finally, from LIMRA, now this is the Life Insurance Marketing and Research Association. They're basically they look out for the insurance people to tell them what they need to know so they understand the products and investment vehicles available to insurance and brokers and professionals and such. And they've said that, look, retirees and pre-retirees are increasingly concerned about the uncertainties around traditional Social Security and safety nets, and as the debate in Washington just brews and brews, the concern is that people are not going to have enough secure, safe income as they go into retirement. And as they're contemplating how to do this, people think that they have Social Security to rely on, and I think they probably do. They may have a pension, but using an annuity may be a viable third leg to your retirement plan. And that's what we're going to focus on today, these third leg retirement plans called index annuities. Some of them have what are called living benefits on them. When we come back, we're going to talk to Josh Goulding, and he's an expert in this field, and he's going to explain the nuances of these things. Can you really get 4 to 7% guaranteed for retirement income? You're watching The Savvy Investor. I'm your host, Michael Canet, and we'll be right back.
Join the host of the nationally syndicated TV series The Savvy Investor and best-selling author Michael Canet for this very important, life-changing workshop. Michael and his team of advisors from across the country have been helping families create and live the retirement they envision by carefully crafting a retirement income plan that can withstand any financial crisis. Michael will give you the tools you need to make sound investment choices and help you prepare for your golden years. At this workshop, you'll learn more than just where to invest your money. Michael will also share tax strategies that could save you and your family thousands in tax dollars. You'll learn important estate planning techniques that can help you avoid the high cost of a nursing home, as well as reduce or completely eliminate any estate tax. Now you can join him in person for these very informative workshops. They could be the answer to creating the safe and secure retirement you deserve. Call 866-597-1040 to see if you qualify to attend one of these workshops with best-selling author Michael Canet, host of The Savvy Investor. Seating is limited, so call 866-597-1040 to join us.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. Today we're talking about those voices we hear on the radio talking about 4 to 7% guarantee rates of return for income purposes. Reality or ripoff? And that's my question to our guest today, Josh Goulding. Can you really go to an insurance company and get 4 to 7% guaranteed for income purposes?
It really depends.
Okay, well, that's a great start. So I want to explore that more, but let's start with the basics, because really what they're talking about is the whole idea of an index annuity. That's really what it is. I mean, just so the viewers are clear, when you hear those people talking on the radio about this investment product that's going to guarantee 4 to 7% and give you a bonus and all that, we're really talking about an index annuity. So let's talk about how an index annuity works. Let's just talk about the very simple basics of an annuity in the first place. Tell us a little bit, tell our viewers a little bit, what is an annuity?
An annuity is an insurance contract which essentially you're exchanging a premium that's paid for a guaranteed stream of income either now or down the road.
So I'm going to give my money to some insurance company, and in exchange for that, they're going to guarantee me some income, some rate of return, or something.
That's correct.
Okay, and the guarantee, because that's a big thing. I mean, we know what FDIC is. It's if you go to a bank, you have FDIC insurance, and it's backed by the federal government. Basically, the Federal Reserve has an obligation to step in if FDIC goes under. The Treasury can print money and can back EE bonds and I bonds and treasuries and stuff. But when we hear an insurance company talk about guarantees, how exactly do those guarantees? I mean, how can an insurance company guarantee that they're going to have the money for you down the road?
Well, an insurance company is essentially sharing the risk of a large number of people. So when you pay a premium, there's many other investors paying a premium as well. And so what they're doing is they're investing a pool of money in their general investment account, typically in conservative instruments. And so as interest rates have come down over the years, what they're guaranteeing you is going to be what they believe to be less than what they can earn over a certain number of years.
So they're gonna take their money. They're going to take the money that this group of investors, the premium payments, they're going to take this money and they're going to go buy a bunch of fixed instruments. So a bunch of bonds, be it treasuries or corporate bonds or something.
Exactly.
Right. And then it's the ability of those bonds to earn interest and or be safe and secure for the insurance company to actually pay you back the money they say they're going to guarantee you.
Exactly.
So it's the claims paying ability of the insurance company.
Exactly.
Right. So as an investor, and I'm not sure investment, I always get nervous when we call it buying an annuity an investment because there's some slippery slopes. Is it a true investment or not? But for somebody that's looking to purchase one of these products, one of these vehicles, and they want to make sure that their guarantee actually has substance, can they go out to a rating agency? I mean, how do they know that the insurance company is actually going to be a decent insurance company?
That's a great question and very important one, especially in this time of uncertainty in the global markets. It's very important to go with an insurance company that has a very strong credit quality. And the two rated agencies that I think are important are AM Best and Fitch.
Right. Certainly not S&P, who just downgrades everybody and tells everybody that they're great until they're not. Right.
And the other one is the Comdex rating, which is a simple way for investors to look at the strength of an insurance company, and it's based on 0 to 100, 100 being the strongest. Anything over 90, I would say, is a very strong insurance company.
So you want to go find either through AM Best or Fitch or What was the company?
The Comdex rating.
The Comdex rating. You want to go out and be able to look at the ratings and say, okay, if I'm going to put my money someplace that I need a guaranteed return of my principal back and earnings back, I wanted it to be a company that's highly rated. And typically you're looking for A ratings, investment grade ratings is what you're looking for.
Absolutely.
Okay, so we've now made the agreement that we're going to go put our money with this insurance company, and they've promised us that we're going to get this rate of return back. Okay.
Correct.
Now let's talk about first, one of the things that just absolutely kills me when I'm listening to the Saturday and Sunday morning talk shows is they're telling us that they're going to give us this 5-10% bonus, and it varies from company to company, but it's really, we're going to give you 8 to 10% just for putting your money in this account. Can you get a bonus? Will insurance company do like a bank? You know, if you go into a bank and open up a new account, they'll give you a toaster oven or some widget or something. If you go to an insurance company, are they going to give you 8 to 10 or 6% bonuses just for giving you their money, your money?
There is a possibility, yes. They can offer bonuses and do offer bonuses when you make that initial investment.
But there's strings attached.
Absolutely.
I mean, because there's no such thing as free lunch. I mean, I have a buddy of mine that says there's such thing as free money, and to some extent this is free money, but it does come with strings attached.
Yes, it does.
So the strings attached are what? You can't walk away with that bonus, right? I mean, it's not like you put the money in on Monday and Tuesday you can just walk away with the money.
That's correct.
All right, so you're giving them the money, and it's got to sit there for a little bit of time at least.
That's correct.
Now, what other strings are attached? If they can take a percentage out, but not all at once.
That's right. So depending on the contract that you have, typically you can take up to a certain percentage out per year, free of any type of surrender charge.
So there are surrender charges when you buy one of these things.
Yes, there are.
And that's always the thing. I listen to people talk about, hey, look, you can invest your money, and you can just, if you ever need it, it's there for you. And the fact is that, well, I recognize there are some annuities out there that have what's called a return of premium. If you decide to surrender your policy in full, like a CD, you're going to lose interest, and you could lose 100% of your interest, but they have a return of principal guarantee. Most of these contracts are designed to be, as you said from the offset, long-term, where you're giving them the money, you have to leave it there for a period of time, anywhere from 5 to 10 to 15 years.
Correct.
Right? And if you're getting one of these bonuses, typically the surrender period is longer. Is that reasonable? Is that a reasonable expectation? Okay. I want to take a quick break here, but when we come back, I want to talk with Josh about how those guarantees work from the living benefit side, because I think for most viewers and most investors at this point, if you're looking for a steady stream of income where you can rely on it during retirement, an index annuity or a variable annuity or something with a guaranteed income stream might be an attractable vehicle, but like we said, there's pluses and minuses to everything we do. And I want to talk a little bit with Josh how they work and what are the strings attached. You're watching The Savvy Investor with Michael Canet, and we'll be right back.
Remember when life was simpler? When things didn't move quite so fast and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, more and more uncertain, we have managed to keep things simple, providing sound, easy to understand financial advice and proven solutions for the road ahead. From investments and insurance to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive, we're your single point of contact, a single call, a voice you recognize well, and a partner who will be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. On today's show, we're talking with Josh Goulding about those 4 to 7% guarantees we hear about from the talking heads on radio. Before we go there, though, before we explain how these 4 to 7% returns actually work, I want to take a little bit of viewer mail.
You've got mail.
So today, Roger in Colesville, Roger has sent us an email and says, he was reading Susie Orman's website, and she says that if you're willing to give up some upside potential, you can also protect yourself totally against downside risk with an index annuity. So I got to tell you folks, most of the time Susie Orman drives me crazy. especially with our new commercials. But the fact is that she has a point here. So Roger's saying that, look, if I want to put my money in index annuities, Susie says I don't have to risk anything in the stock market. How does that work? Is that true?
That is true. You are not invested in the stock market in an indexed annuity. And there's two sides to this. The one side is if the market goes down, let's say 20% in a year, you're not going to be subject to the downside. However, if the market were to go up 20%, you're also not going to participate fully in the upside. So you're giving up some of the upside for the protection on the downside.
Which is exactly the purpose of them in the first place.
Correct.
And so I think Susie's point here is, Roger, is that, look, if you're willing to give up upside potential, if you're willing to take 3, 5, 7% rates of return in good stock market conditions, you can avoid the negatives, 5s, 10s. Heck, if the stock market is negative anything, you do not lose money in these. But the flip side, like you just said, is that you're giving up the upside potential. So if your overall goal is maybe 3, 5, 7% rates of return without market risk, this might work for you.
That's correct.
Right. All right, so now we're going to go from Musa in Atlanta. Musa writes, evidently he attended a workshop, and the speaker suggested that one of the benefits of owning an annuity was the tax deferral. And his question basically is, does the money eventually get taxed? And I think this is one of those things that I think drives regulators crazy. The whole idea of selling annuities based on the tax deferral side of it, especially when somebody puts it into an IRA. So you have this IRA that's already tax deferred to begin with, and the investment vehicle is an index annuity or annuity of any sort, which is tax deferred. But so tell us a little bit how this tax deferral works. What's going on there?
Well, I think you raise a really good point, which is if you're buying an annuity in an IRA, the tax deferral feature of the annuity is moot,
right,
because it's already tax deferred. However, if you have money that you don't plan on using for a long period of time and you want to have some type of minimum guaranteed growth with upside potential, if you invest that, what we call non-qualified money, into an annuity, it will grow tax deferred. But as you pull that money out, it has the potential to be taxed at a higher rate if taxes were to go up, and it's taxed at ordinary income.
And I think Musa, that's a key thing. If you're buying the index annuity for strictly tax deferral purposes, I understand that. It does make sense sometimes to postpone paying taxes, especially if you think interest rates are going to go up in the near future. The difference is, though, if you're using stock or equities, things that you're currently paying capital gains tax on, and you're changing that into an annuity, when you take the money out of the annuity, you're going to be paying ordinary income taxes, and it looks like tax rates are probably going to be going up for most of us in the near future, especially with the economy being the way it is. So I would tell you that while the annuity may make sense for some reasons, tax deferral certainly being one of them, you have to measure the tax today versus the tax later. And both of those are great questions. And we know retirement planning is daunting and overwhelming. Send us emails anytime you'd like. We answer them here on air, and even if we don't get to you here on the air, we will respond to you immediately. So email us questions, anything about stocks, bonds, anything you have about retirement planning, we get to you immediately. All right, so Josh, I want to go back to when we left for commercial, we were talking about those guaranteed living benefits. That's where we were going. And we talked about the bonuses, and we talked about this whole idea of if I give an annuity company $100,000 and they give me a 5% bonus, all of a sudden I have $105,000 in my account. We explained that that's not money that you can just walk away with. There's strings attached to it. It's not necessarily a free lunch. But now that I have this money in the accounts, they're promising me that it's going to grow at 4, 5, 6, 7%. Let's talk a little bit about how that works. Let's just, for simplicity, for simple math, I know there's some out there that do 4, 5, 6, 7. I know there's all sorts of different rates. But for simple math, let's just assume it's growing at 5% rate of return. What exactly does that mean for the investor?
That's a great point, and it's important to distinguish between what the account value is growing at and what the income base is growing at.
Okay, wait. So
sure.
There's actually two sides to the equation here. There's an account value.
Yes.
And then there's an income base value.
Yes, that's correct.
Okay, so the account value side, that's what we were talking about with Roger, that it may go up, but it won't go down.
Exactly.
But that's worth whatever it's worth at the end of the time period.
That's exactly right.
Okay, so if the stock market goes up, you get some percentage, certainly not all of it. And if the stock market goes down, you get nothing.
Correct.
There might be some minimal rate of return that they pay you, but it is minimal.
Exactly.
That's what actually happens.
Yes.
Then there's this guarantee side. That's always the slippery slope, I think.
That's right. That's right.
So on the guarantee side, let's say 5%. Go ahead, explain that to us.
This is so important. So the 5% guarantee that the annuity company is promising is based on this income base. And what you're essentially doing is you're guaranteeing, the annuity company is guaranteed that the payments that you're going to get down the road will increase at a certain rate, which in this case 5%. So it grows 5% for, let's say, 10 years.
So if I gave them $100,000, just take the bonus off the table. I gave them $100,000, and ignoring compounding for simplicity's sake, 10 years from now, the 100 is now 150.
Yes.
I can't walk with that.
You can't walk with that, but what you're essentially doing is now you can pull, what the annuity company says is you can pull a guaranteed income stream. Let's, again, for simplicity purposes, say 5%. So you can pull 5% for the rest of your life, depending on the contract, off of $150,000.
So I could take basically $7,500 a year guaranteed for the rest of my life.
Yes.
By the insurance company guaranteed.
You got it.
So what happens if I'm married? Is there something available for my spouse?
Yes, there is. Some companies actually have the ability for you to guarantee the income over your life and your spouse's life.
Okay, so then it sounds that if I'm looking for some sort of guaranteed income stream, I mean, clearly Social Security, we can argue and differ about whether it's guaranteed, but Social Security is an income stream. I may have a pension, but if I'm looking for a third leg of that pension stool, of that income stool, if I'm looking for someplace else where I want to make sure the money comes in every month, using a living benefit rider on one of these annuities may make sense for some people.
Absolutely.
Okay, so they offer a bonus. They offer these guaranteed income benefits. Both of them are based upon the claims paying ability of the insurance company.
That's correct.
There may be surrender charges, right? You can't just walk away with all that money at the end of the time. Are there typically fees involved with the living benefit? Sometimes, maybe?
With the living benefit, there typically are, it tends to be in the range of 0.65% to 0.85%. Could be higher, could be slightly lower. It really depends on the contract. And in exchange for that, you're getting a guaranteed income base that's increasing and a stream of income that's guaranteed over the course of your life and potentially your spouse's life as well. Now,
what happens if you do not use all the money? Is it a possibility if I don't spend all the money that's in this contract, is there a death benefit, or can it come back to my spouse? And you know what? I want to hold that thought. When we come back from our break, we're going to talk about what happens if I don't spend the entire thing. You're watching Mike Canet on The Savvy Investor, and we'll be right back.
Join the host of the nationally syndicated TV series The Savvy Investor and best-selling author Michael Canet for this very important life-changing workshop. Michael and his team of advisors from across the country have been helping families create and live the retirement they envision by carefully crafting a retirement income plan that can withstand any financial crisis. Michael will give you the tools you need to make sound investment choices and help you prepare for your golden years. At this workshop, you'll learn more than just where to invest your money. Michael will also share tax strategies that could save you and your family thousands in tax dollars. You'll learn important estate planning techniques that can help you avoid the high cost of a nursing home, as well as reduce or completely eliminate any estate tax. Now you can join him in person for these very informative workshops. They could be the answer to creating the safe and secure retirement you deserve. Call 866-597-1040 to see if you qualify to attend one of these workshops with best-selling author Michael Canet, host of The Savvy Investor. Seating is limited, so call 866-597-1040 to join us.
Remember when life was simpler? When things didn't move quite so fast and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, more and more uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and proven solutions for the road ahead. From investments and insurance to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive, we're your single point of contact. A single call, a voice you recognize well, and a partner who will be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come.
For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
If you're in retirement or retiring in the next 3 to 5 years, you must read Michael Canet's best-selling book, Surviving the Perfect Storm. Best-selling author and National Quill Award winner Michael Canet's Surviving the Perfect Storm is a must-read to prepare for your golden years. This amazing book can be yours absolutely free, but you must call 866-597-1040 now. Supplies are limited, so be one of the first 25 callers to receive your free limited edition autographed copy of Surviving the Perfect Storm. Call 866-597-1040 now.
Now keep in mind that just like any tool, there is the right tool for the right job and a wrong tool for the wrong job. We have just scratched the surface here, and you'll want to know more about how today's conversation might or might not fit your needs. Ask about fees, surrender charges, market risk, interest rate risks, how the guarantees work, liquidity, and much more. Remember, the right tool for the right job.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. We're joined by Josh Goulding today. Josh, when we left for that break, we were talking about death benefits. So if I'm taking income off this, one of the big concerns people have is that what happens when I die? In these things, is there any money left over for my kids?
Possibly, yes.
Okay.
For every time you take an income distribution, your account value is being reduced dollar for dollar by the amount that you take. Once that goes to zero, you can still get income if you continue to live, but if you were to pass away, it's gone. Conversely, if you pass away before the account value is to zero, your beneficiary would receive what's ever left in the contract.
So if I haven't used all the money, there's something left over for the kids, but if I've used it all up, I've used it all up.
That's correct.
Folks, index annuities with living benefit riders are a viable tool for retirement purposes. They are long-term investments. They are a great source of retirement income. They can do this for you, but there are strings attached. Now, before you go do one of these, before you buy one of these, make sure you understand the nuances. Make sure you understand surrender charges, how the guarantees work, how you're going to take income. They can be the right tool for the right reason, but they can be a disaster used incorrectly. Now, each week we try to make you a better informed decision maker here, and we believe that you should take the least amount risk possible to accomplish your goals. After all, at the end of the day, it's not how much you make, it's how much you keep. We'll see you, the Savvy Investor, next week. If you'd like more information about today's show, you can contact our offices with our toll-free number, 866-597-1040, or visit us on the web at www.thesavvyinvestortv.com. When you visit our website, sign up for our free weekly newsletter where we give you tidbits each week to help you make smart money choices. Every retiree's goal, from our perspective, is to take the least amount of risk possible to accomplish your goals. Too often, financial advisors and stockbrokers assess your risk tolerance. Just because you can tolerate the risk doesn't mean you have to accept it. Remember, at the end of the day, it isn't how much you make, it's how much you keep.